So for instance, if I was identifying this area here, the first thing I'm going to do is, all right, so here's a price point, right? I'm going to grab my horizontal line. This is the lowest price over here before the market started retracing upwards, right? So my goal is, if that's my lowest point, I'm always going to look for either my previous lowest point or the next lowest point. So if we can identify based off this information here, there's one low. Let me zoom in so you guys can see. This is one low, right? And this is another low. So right now I have both support and resistance, which identifies as one zone. Another area of support or resistance that I can focus on is from here and here, right? So now I'm able to identify two areas that I can identify as a supply or demand area. So as always.
So to make it clear, one, you go off the a downtrend or a bullish off, and then the other trend would be a bearish. The other line.
With this line over here. So yeah, the market was going down. So I'm first going to identify where the market dropped to, and then this is, to me, is considered a rejection because of the fact that the market hit this price and then started going up, right? So I identified one price area here as from this low and the low after, right? Because I don't have any lows to identify here prior to this in this time frame. And when we speak about, analyzing the market in different time frames, you'll understand why for now I'm going off of this low and the actual low after this, right? So for me, the importance is just to identify multiple zones in this time frame so that I can understand as the market is approaching or is at that point. For instance, here the market was in this zone, and prior to faking out, it shot up. Notice how here the market now broke back into the same price. And I'm just going to highlight it with a rectangle, right? So I have one zone here. Notice how multiple times the market faked out, right? So that tells me that somewhere around here, there's another support area, right? So I can either identify the support or look for the zone over here. So if this was the low, let's say this was the next low, I can identify the zone here. So what confirms this possible zone here, right? The market faked out a few times over here, right? And it wasn't until the market retested that zone and shot up. See the fake out? And I'm going to use this tool here with different colors so we can identify that. So see the fake out? The retest right here? The market faked out of the zone multiple times over here, but it wasn't until the market retested the zone and started making its move to the upside. So for me, when I tell you guys to identify the zones, right, one of the things I see everyone getting confused with is that they're identifying every single zone possible. So their charts look something like this.
Yeah, and that's what I don't want to do.
Which is fine. The importance is for you guys to understand what's happening, right? Because if I show you some of my charts when I'm trading, sometimes it gets overcrowded, but I at least understand what's happening, right? So I have my zones here. We spoke about trends and channels, how the market shifts from an uptrend or a downtrend, right, to an actual uptrend. So let's say that this was the last touch of the trend like we spoke about. Here was the retest of the trend point. See, so this confirmed that the downtrend was no longer valid. And notice after the retest, the market made its biggest move to the upside.
Shut up.
So for me, when I'm telling you guys to identify your zones, when we get into the topic of, you know, in True Profit Academy, I call it the 3-step system. You know, the reason I call it that is because I'm following 3 steps in each different time period. So if I'm looking at the monthly, weekly, and daily, I'm looking for something specific. You understand? Mm-hmm. But in general, the importance is for you to understand everything, right? We discussed in the beginning of the class that when learning everything that we're teaching, it's to understand, identify, and apply. Understand the information so that when I identify it, I can apply it to my chart or my trading. So the whole important thing for when identifying zones, I don't want you getting too zone happy, but I at least want you to understand what's happening, right? If this was a zone here that we were paying attention to based off these 2 touches here, the important thing is to understand if it confirms it or not. So what happened? The market reached this price here, couldn't break it. What? Why? The importance is, as we've discussed in the past, it's important to know what happened before. Prior to that, notice what happened. The market broke into the zone, right? Mm-hmm. And to confirm that that breakout was correct, what does the market need to do? It needs to come back and retest it. Correct. So what did the market do? After the retest, it slowly started coming down. What happened? It couldn't break whatever price was indicating here. You see? So for me to get all zone happy, it's important, but also to understand what these zones actually mean. So when identifying your zones, the importance is to understand not only what happened prior, but what's happening now in the moment so that you can have an understanding. Okay, I saw that the market broke into my zone over here. Let's say this, I'm going to draw this zone again. I saw that the market broke into the zone and it failed to break above it. So what am I paying attention to? I'm looking left and I'm identifying the next zone that the market needs to respect, right? So whatever. Here the market faked out, right? If she were to go up, I need to see the market retest and continue going up, or the market fake out again and retest again. Make sense or no? If that makes sense, everyone type 1. If it doesn't, let me know where I lost you. Perfect. So whenever you're analyzing the market, your thought process should always be, it shouldn't be, all right, if I enter this trade now, where can I take it to? No, the importance is to understand what happened before and after, before we take this trade, so that while we take the trade, we're not busy looking for what else is happening, but we're already prepared for what's happening. Make sense?
Yes.
So, perfect. So if this was if let's say these were the 2 zones that we identified, right? And I'm going to use red for now. Then I'm going to look, okay, when the market shot up, it came back and retested. What did it retest here? All right, so if I look for a zone from here to here and drag this across, when the market broke out and retested and kept going higher, now I understand why when the market broke down and retested up here, why the market came back down, retested again, kept going down, and then when it broke above, it retested that same price again. It tells me that there's an important level here. You see? So when you're identifying price, it don't matter what time frame you're on. Let's say we're looking at the 30-minute chart. And I'm looking at what happened in the past, right? So in the 30-minute time frame, I can't see what's happening. But let's say We go on the 4-hour time frame, and I'm going to look at what happened prior. Well, here's a rejection. Here's the market going across. If I drag this zone, guess what happened? When the market broke in and broke back in, look at the price that the market retested before continuously dropping. Right on that zone. So I don't want you guys getting caught up trying to like solve like the rocket science behind the market. No, it's just understanding the simple laws that we've spoken about, right? And those simple laws is what? Every breakout, and I'll put every breakout and fake out is confirmed by a retest. Yeah, I got you. So I simply focused on this price over here, right here, this drop. The market shot up, came down, couldn't go any lower. So what happened? The market retested, respected, and kept going higher. I just simply drew based off of this low right here and this low right here, which gave me a support and a resistance. If I drag that price across, which is how I got that zone, I can pay attention to how when the market dropped all the way down here, we can see how this was an area to retest, right? So let's talk about another zone. Okay, so below that, this is where the market failed to break. So if this was my low, and this is the lowest point, right? Then I'm going to draw my zone from here, and I'll extend it. Excuse me. All right, so we have that zone there. So if I look above this zone, right? Now there's many zones in here. There's many zones I can look at. Okay, the market shot up here, couldn't break that point right here. Or if this was my high and my previous high was right here, well, how does that make sense if I drag the zone or I highlight that zone all across? So what happened? After this retest, the market broke it, came down, respected, and then kept going down. Right now, in this current drop, we're understanding what's happening based off of what? Previous data. So does that make sense to you, Aurelio?
Mm-hmm. Yeah.
So we spoke about candlestick patterns, right? And candlestick patterns and formations that signal that the market is going up or down. How do we confirm that? Well, here, right here, we see that the market faked out. The market faked out to the downside, couldn't break here. But what I'm paying attention to is that there was one shoulder here and another shoulder here within this descending channel, right? That signaled that the market was going up. So how do I identify a zone above that? Well, if I go off of this high right here and I go off of the high before, guess what I have here? Another zone that is confirming not only every time the market reached the top here, but why when she broke into the zone and respected the bottom of it again, she dropped. Did the same here. Broke out, couldn't hold, dropped. Came back, dropped, right? Again, it wasn't until after this fake out here, and what I mean by a fake out is that it faked into the zone, never retested here. See how this current price action here never actually touched our zone? So what happened? Even though the market dropped all the way down here, look what the market eventually winded up doing. Coming back up to retest the zone to eventually create an even lower point, right? Does everybody understand that? And Brandon, let me know if that makes sense to you. I know you want to talk about that zone. Perfect. So we spoke about trends and channels, right? So a zone a zone is a horizontal channel, right? We've spoken about ascending channels, right? When the market is going up, if I found the support, then I can identify the resistance of that trend. So let's say this is the channel here, right? Here's one channel. This is an ascending channel. Let's talk about a descending channel. Notice what happened. The market faked out of the channel, shot back up, retested the top of the channel, and kept going up. What happened? The market faked out of the channel, came back up, didn't retest the channel, but what did it retest? If I go off of the high, right, and I look at either my previous high or the previous highest point, I'm going to go off of this high right here. So let's say this was my highest point, and this was the previous point. What the market did here was that it respected the zone here. And it doesn't even have to be the zone. Let's look at the bigger picture of what we've been talking about. So if this was the price where the market respected, what is the market doing? The market broke down, respected my area, came back down, and cleanly retested my zone or my breakout. Notice that here, the market respected what? The price area here, but it didn't respect the price point where the actual breakout occurred, whereas where the market actually finally did it here. See how even though the market dropped, she came back up, respected cleanly, and then dropped. So let's talk about what we've spoken in the past. So every breakout is confirmed by a retest. So here's your breakout. Here's your breakout in a smaller time frame where this breakout occurred. Excuse me, the market did retest here, but what happened? It couldn't break this point here. So let's say we identify that rejection area right there. So if this was my rejection area and this is my low point, I'm going to identify my previous low, right? And what do we have here again? Another, right? And we'll change the color so we don't get confused. So what happened? When the market broke up to the upside, notice what happened here. The market never retested the top of that zone. So while she kept going up and couldn't break above here, she finally came down to recover some of that movement to the upside, retested. Where did it retest? Right here, right? Shot up, retested this breakout. So now we have the actual retest. Right? And notice how the movement to the downside was way greater than the previous. So what is this telling me? If I look for confirmations of what we've been speaking about, right? Not only is the market showing me everything I need to know, but check out this pattern here. We have one shoulder, we have the fake out, we have the other shoulder, and the market dropped, right? One confirmation, perfect. Not only that, if I go off of market structure like we spoke about, right, here's the trend, right, here's the fake out, here's the last touch. Notice where the market actually respected that last highest low point before the market broke it on the same price area that the market last touched that trend line. So when we discuss the opportunity of putting it together, and let's say we've identified that, right? Cool. I understood what? That the market already had done this retest. And let's say I'm like, shit, I missed out on this trade entry. The next focus should be on what? If I missed this entry, which was technically, in my eyes, I believe is always the best entry for sales, then I'm gonna look at what was the touch before that. Well, here's my other touch. Here's my other touch. So if the market couldn't break it here and it broke it here, I'm looking for the what? The retest. What is this telling me now? I got another entry potential, but as long as it breaks the zone below. So if I took this trade here, and I give you the assessment of if I took the trade, I'm going off of what? My last touch or the first touch to the trend. So if I go ahead and let's say I delete this zone here, and I'm going off the first touch, right? This is the zone that we want to pay attention to. If the market breaks it, right? Let's say the market reached this point, and this is where you set your take profit, then cool, you entered your trade, and from here to here, you made 235 pips. Now, I know when I talk with Janelle, she always says, oh, you know, you always make it look you always make it look more simpler than when you're actually doing it. So let's go back to it. Let's find another example. We missed the opportunity to take a trade here. Why? Based off of the simple things we've learned, right? Market structure, trends and channels, supply and demand. Cool. Everything starts looking complicated when you start filling out your chart with the information you're seeking. But the important thing is to identify what? If I'm taking this trade, I don't want to take the trade and then look for what happens. No, I want to understand what happened before so that while I'm riding the trade, I know what areas to look at. I hope everybody understands that. If you understand that, type 1. If you don't, type 2. So I'm going to say it again. It's not about entering the trade and then figuring out. No, you want to know what's happening before you enter the trade. So when you do enter the trade, right? I always use the terms best case scenario and worst case scenario. You're already prepared, right? Because if I entered my trade off this retest, right? I know that the last touch of the trend was up here. So even if, you know, I've sent out trades where we take a L, but let's say the market faked out up here or even kept going higher. The main focus was to go down. But unfortunately, when we took the trade, the market went against us, but it never respected and retested that area. If anything, it broke above, couldn't create a high, and then broke down. What does that tell me? Okay, it's not that I'm wrong, I was just early, right? So when I take a trade, I understood what? That, I'll give you guys an example. AUDJPY the other day, I called that out. I knew it was going to go up, but unfortunately, when I took the trade, I didn't keep in mind that the NZD news was going to affect it. So what happened? I didn't understand that worst case scenario. So when the market just kept dropping and dropping and dropping, at that point for me, a mistake that we all commit is what? We get committed to our analysis and not what's actually happening. So let's pull that up, AUDJPY. And I'll show you guys what I mean by that. So here's AUDJPY. So I had this zone observed, right? And I called out the trade at 72, I think it was 72,500. I'm gonna delete this zone here. So I called out the trade around 72,500. I think it was like the retest of this area here. So once I saw that the market broke above here, I believed that the market was going to go above. Instead, what the market did was it dropped. But notice what happened. If I look left, right, the market has never been down that low till just about, what is this, September 26, 2011 was the last time the market reached an area here. So I'm going to draw this area here. And I'll go back to the 4-hour chart I was looking at. So the mistake I committed was I didn't pay attention to the longer time frame. So when I saw that the market, as it dropped and it tried to come back up, what sold me was I bought this idea right here. Oh, we have a pin bar, we have a bullish candle, this shit is going up. I jumped on it. Yo, let's buy it. Perfect. But what I didn't see was the market attempted to break that area. It didn't. It didn't. What it did was it confirmed that this was a fake out. But look how many retests. 1 and 2. And then what happened? The next candle engulfed the previous candle and then just dropped. This is when the news event dropped. So what did the news event do? It created a low, but notice what it couldn't do. It couldn't break and retest. If anything, it broke down, shot all the way down, and then broke above, retested, and now is making its move up. So that's why I want to share with you guys that it's not about having it incorrect. This is where you guys, as you guys all start to understand the market and understand potentials and understand what is affecting it, this is where your management of risk is, right? You know, I entered this trade on a $1 lot. You know, I lost like 70 pips, and I had another 50-cent lot and lost 65 pips on that. So in total, it was like $1,300 in drawdown and negative that I lost. But the potential of me making money on that trade, I was looking for just about a little over that. So for me, I was okay with taking that loss if it went that way. But what I didn't pay attention to was after the market, I think I called to adjust stop loss at 71,800, which was just right when the market was creating these dojis right here. Right here. And what I didn't pay attention to was, let's drop down real quick to a smaller time frame so you guys can see. I didn't pay attention to the fact that this area here that the market attempted to break out, the market was not able to create any highs. It couldn't create any higher highs. It was creating lower highs. So what happened? I bought into it. Yo, this shit broke the trend. I'm in it. What happened? 30 minutes later, that news drop came all the way down. So this is why I tell you guys, Confluence is very, very important. Confluence is what's going to help you not only make the adjustment, but actually give you confirmation if this trade is ready or not. See, I called out this trade at 72,500, right? Let's buy here. Once I saw that the market was unable to hold above this zone here of 71,800, where all these candles were having traffic or trouble breaking, right? Once I saw that it couldn't break above that and it couldn't break back above the 72,100 area where this support or this supply area was, I should have gotten out of that trade. But the problem is, like I tell you, and this is stuff that no matter how many times you work on it, it's gonna happen. You understand? And for me to stress this out to you guys, if we as a group are all learning based off of our wins only, how much can you really learn? But if you learn off your losses and you look back at what happened during your loss, or okay, I took the loss and let me see what happened, and actually do what you didn't do prior to entering that trade, you'll always be surprised with, you know, how much you can learn off of that. Because check it out. Let's say we simply just extended this trend line here. Notice what happened. The market broke above, faked out, respected the zone that it faked out of here, and shot up instantly. So cool. I took this trade 72,500. I lost about 160 pips if I would have closed at the bottom. But if I would have identified when the market couldn't break above this area here and it retested, if I would have taken this trade back up to where it has, I could have, with a higher lot size, understanding what happened and that this was a news event. And as we've spoken about, right? When the market drops or rises due to a news event, over time, it will slowly come back to recovery. Sometimes faster, sometimes slower, depending on which news it is. And we'll get into that. But if I would have understood this, I could have made back what I lost here and more with the proper risk. So the importance is there's always an opportunity. And the opportunity isn't just a financial gain. Sometimes it takes for you to lose to assess. But this is why I stress to you guys, right? No matter how good of a trader you become, no matter how consistent you become, you're bound to fail. But when you fail, you have to be prepared to learn from it. And that's why understanding and applying all this information is key. Because when we identify opportunity as traders, we must have great judgment to attack that opportunity. And if we miss opportunity, there's always going to be a bigger and better one. Okay? So let's talk about candlestick patterns. Let's talk about everything we've discussed. We've said in regards to if the market drops and it creates lower highs and lower lows, let's say that's a reversal pattern. Or here we have the market creating lower highs and lower lows, but what happened? The market broke that support, right? The market broke that support. We've spoken about how 3 touches confirm a trend, and on the 4th touch, usually you'll see that the market would either break it or respect it, right? So we see one. How many times the market touched this area here? Yeah, 1 touch, 2 touches, 3 touches, 4 touches. The market couldn't break that resistance. What did it do? Come down, ranged right around not only this support area, but also our zone here. And once it finally broke, it broke strong. See? So then the market came down, respected these zones, came up, and then this time, what happened? If this is a breakout, then this right here is the fake out confirmation, right? Respected that area. What happened? The market couldn't develop any bullishness. We should have seen that negative effect towards the market. But because we didn't assess the market in this sense, or in my term, I didn't assess it, that's why I took the loss in this trade. So does anybody have any questions in regards to what I've just discussed before I move forward? But I want you guys to understand that what I'm teaching you and how you guys are applying it, right? We spoke about support resistance, supply and demand, trends and channels, right? And how we've been able to apply it and to see, yeah, hindsight, we could have seen it. But had I understand that this was a breakout of the zone here and this was the retest, I should have known it was going down. How further low? Yeah, we can't predict that it was going to drop all the way down to here, but I at least would have been able to know that because this was the lowest point and this was the lowest point, that this was a possible target, right? From here to here, that's 80 pips in an hour from the news. And if you would have read your articles, you could see that the negative news was from New Zealand dollar affecting the Australian dollar guess what? Now you know. Next time there's a big red flag for the New Zealand dollar, you better be careful for the Australian dollar as well. So if you have any questions, type 0. If you don't, type 1. And Janelle, I saw you had questions before, so why don't you go ahead and tell me what questions you had?
Hi, Jose. My question was basically looking for the sell or buy signals in different time frames.
Mm-hmm.
So we need to get the 3 signals before we actually set a trade?
For me, let's say you're taking a trade, right? You're looking at entering the market, and you're like, I believe that the market is going to go. I believe the market's going to drop. These are my confirmations pointing me to the market going to drop, right? When you're entering the trade, I want you to be sure that those 3 confirmations are clear, right?
Yeah.
And before you enter the trade, I want you always identifying not only where would you close your trade, but where would you take your trade to? Does that make sense? And now, when assessing the entrance of the trade, Janelle, the importance is not only where to or where can I close or where can I take profit, but also assessment of, is it worth me throwing all my money at this trade right now?
Yeah.
Right? Let's say you see a trade and everything in its mother is showing you is going down. Then that's something you want to consider trading with a bit more risk than something that you're kind of like iffy about, but you feel like you have the confirmation. Making $100 on a trade compared to making $2,000 on a trade. Yes, $2,000 is amazing, but $100 is still a win, right?
Yeah.
So that's one of the things I want you to use. So when we talk about confirmations, part of that is you would ask yourself, all right, last time I entered a trade on a sell, and I was a bit aggressive on it because I kept entering and entering because of what? I got married to the trade and I wasn't seeing what was happening. Next time you enter a trade and you see that the trade is going wrong on you, your intention should be, all right, let me look at what's happening. And if it looks like the market is no longer doing what I thought, let me get out of it. I don't want it to be a situation where you're like, you just keep entering sells because you believe it's going to drop. And it doesn't matter to cut your trade short and then a few hours later, the market goes in the direction you wanted it to. It's better to get out when there's uncertainty, right, than to be in a trade and be stressed out about it because it's negative. Because one fake move with the wrong risk is just as bad as you missing it.
Yep.
Make sense?
Yep.
The difference between you missing that trade and you actually being in it is now you missed a trade and you only lost out on potential profits. You didn't lose in negative. You didn't lose physical money or actual money. Being in the trade, and let's say you entered this trade heavy and you knew it was going to go down, but before it went down, it did this move to the upside. And because you over-risked your account, when the market reached this point, it closed out your trades and then all this started happening.
Yeah.
You understand? So 3 questions I ask myself, and I'll share this with you guys all, because I know you guys want to also understand the mindset behind when I decide what lot size. For me, as someone who's trading for a living, the first question I always ask myself is, is it worth it? Right? And what I mean by is it worth it is if I'm trying to make 50 pips, right? Because I understand where I'm entering my trade and where to. If I enter this trade on a high leverage and it hits my area or reaches that point where I want to close the trade, is it worth that loss, that win? Or should I lower down my lot size and potentially enter multiple positions as opposed to one large position? Make sense? So let's say let's say I'm looking to make 50 pips, and instead of me entering one position at, let's say, $1 lot, I'll enter one position at 25 cents. And if it goes wrong on me, I'll enter another position once it confirms that it's worth it. But I'll be able to take a 25-cent trade, 30 pips negative, easier than a $1 lot, 30 pips negative. Does that make sense?
Yeah.
So the second question I ask myself is, all right, I spotted the opportunity and the confluence pointing that the market is going down. Is everything else matching to it, right? We've spoken about in the past for you guys, FinViz, right? FinViz is like a strength index meter. So let's say I wanted to sell NZD USD, but right now, NZD is way stronger than the dollar in this page, right?
Yeah.
Is it worth knowing that the dollar is weaker than the New Zealand dollar to even try to over risk that trade right now? No, I'll enter the trade on a smaller lot size that even if the move does happen that I believe is going to happen, at least I made some money, right? As opposed to missing it or losing out on this trade because it went bad on me. Does that make sense?
Yes, it does. Thank you.
Now, the third question I always ask myself is, okay, so I understand if it's worth it. I understand if the market is going in my favor. The next question I always ask myself is if this trade is going to make or break me, right? If I have a $500 account and I'm trying to make $500, is me worth losing the only $500 I have to invest to try to double it? Or would I feel better building it up over time, right? Because 5 winning trades does you better emotionally and technically than one large trade. It's always good to win big, but as always, it's always better to win consistently. So that's what I want you to ask yourself, right? Aside from everything you're looking at the market. Once you're looking at all this, everything that we just discussed, it's all about improving your judgment. Your judgment, and what I mean by judgment is like actual like understanding. Okay, like, yeah, I know the market is going down, but is it going down now? Right? Because let's look. This is 30 minutes, right? Let's say the market retested this area here. This was the breakout level, right? The market broke out. Okay, I understood that the market was going to go down here, but look how much time it took before it actually went down. Almost 18 hours. You understand? 18 hours of the market moving up and down for 20 pips. After that 18th hour, it took 13 hours for the market to drop for 147 pips. But pay attention. Look how much time it took from here to here within that 23 pip range, where 11 hours and 30 minutes, the market did not move much. It just kept going up and down, up and down, up and down, up and down, up and down. And it wasn't until an hour and a half later that the market made its actual move. So you see why understanding all of this and being patient. See, I know I'm not going to get every trade right? But for me, I understand that when I enter a trade, I'm not putting myself in a position where every trade I take, I'm putting myself at risk because I was trying to win big. Throughout all this time, from here to here, almost a whole day of no movement, right? I put myself at risk to lose what I was cool with losing, as opposed to throughout all this day waiting for that move to the upside and then it just go wrong on me for me to just blow my account. I think that's gambling and that's greed, no? But obviously without us understanding that or knowing that, it's just kind of like entering the market blindly in a sense. But thinking about it from like, for everybody who's had it happen to them, where they built an account to a certain amount and then, in one trade or two trades, they just blow it all. what do you always learn? What do you always look back at? What did you learn from that trade? Are you looking back at your loss, or are you just looking for the next trade? You know, those are the things I want you guys asking yourselves, because everything else, and you know, I know Janelle has seen it, I know Brandon has seen it. 90% of the times when we're trading in the morning, we're just looking for confirmations to attack the trade. I'm not complicating myself like, oh, it didn't break this level here, or, you know, oh, it's always waiting. All right, let's wait for the market to reach this level here and break it. All right, it broke the level. All right, I'm going to enter the trade when it retests and shows me that it's no longer going up. Boom, it retested it. Cool, I'm taking my trade to the sells, all right? Prior to me identifying it, I said I knew the market was going to drop to 72. All right, I took my sell here. I know I'm going to 72. So it hit 72, I'm not taking profit. All right? It's not as complicated as it seems. The most complicated task is controlling yourself. So I know I said a lot, and I hope I didn't lose anybody. So before I go ahead and talk about Fibonacci's, does anybody have any questions about what we spoke about just now? If you do, type 0. If you don't, type 1. And I hope I injected some clarity to you guys. Let's see, yeah, Don, how you feeling? Yeah, I know. I'm actually pulling out my charger now.
I'm fine, thank you, bro.
Do you have any questions, or everything makes sense?
No, everything is okay. Gotcha.
Perfect, perfect. How about you, Brandon? Evelio, how you holding up? Did I lose you, or you with us?
I'm here. I got it.
Perfect.
I'm good. I lost the screen for a second. Everything makes sense.
Perfect, perfect. Jeffrey, Conrad, how you guys feeling?
I'm good.
Good. I'm good. I understand.
Perfect. What were you saying, Conrad?
I said I'm good. I'm good.
Awesome. Let's see. But you know, and I asked you this too, Conrad, because I know from our previous conversations, you know, sometimes when we take a loss, it's hard to bounce back, right? But the importance is what I'm trying to emphasize to you guys is like the more you keep shit simple, right? The more we can continuously do things over and over and over again. So when let's say I find myself like going through like a really tough losing streak, right? The first thing I always do is I always look at my losses. What am I doing wrong? And I tell you, every time I look at my loss, you know, I always realize that it's always been because I was, you know, I was either trading with the mindset of like, fuck, I lost, or, you know, this happened to me and now I'm trying to build it back. Or, you know, I look back at the markets and I always see, man, it's crazy how one little simple thing that I missed out on made the difference on the trade, right? Like how I was looking at buys, but because I saw this fake out and then I got sold by that fake out, I changed my mind and I entered on sells and the market shot up. You know, the simple thing is to understand, right, the following. Keeping it simple, being consistent, and what being consistent in profit is being consistent with your analysis, right? And another thing too is, if you're having a bad day in your real life, you should not be looking at a chart, no matter how much money you need. Clear your mind, just like how you don't want to show up to work in a bad mood, you don't want to show up to trade in a bad mood, or stressed out, or overwhelmed, or whatever. All of that ties into each other. So let's talk about fibs. So everybody here understands market structure, right? Let me know if you understand the concept of the market structure well. We spoke about how the market shifts from an uptrend to a downtrend. right? And how a downtrend shifts to an uptrend, right? We're paying attention to the higher low points, which is the touches to the trend, not the fake outs, right? And on the third touch, right, we would identify the support of that touch. And when the market breaks the trend and comes back and retests, the area we're looking for is the retest of that last touch of the trend, right?
Mm-hmm.
And the same goes for a downtrend. On a lower high, excuse me, on lower highs, we're identifying the touches to the downtrend, and we would identify the resistance of that last lowest high point. And when the market shoots up and breaks it, comes back and retests, it's that same price point or price area, right? And then that would signify that the downtrend is no longer valid, and now we're in an uptrend. So what we're going to talk about is how to measure the actual retracements of those markets. So Fibonacci's, right? Fibonacci retracements. Fibonacci retracements are basically they're percentage levels that when the market tends to avoid to break or it does break, they have a certain reaction. So let's say the market shot up and then came down. Well, understanding what percentage of the market retracing back up or down after what happened prior is important to understand, because every time the market, let's say, was on an uptrend and then the market shifted down, right? How many times have we seen when the market breaks out, right? A breakout is confirmed by a what? A retest. So not only is understanding where the market broke out and retested, let's say it's a price area or a zone, a price point, right? It's also important to understand what Fibonacci level, right? What percentage it hit and then retraced to. So the first one, I want you guys to all write these levels down, right? 38.2, 61.8, 78.6, 88.6. I know some of you guys have seen Andre in the webinars. He'll show you guys some different Fibonacci levels. I use the basic ones. Other people go on and learn about different levels. I encourage you to go learn from someone that understands those different levels better than I do. As I've stressed out to you guys, I'm not somebody that I don't know it all. I just understand what I understand, and I'm good with what I understand. And that's why I relate to you guys. But the importance is to understand what happens around these levels, right? So understand that the price points, right, 38.2, 50%, 61.8, these are price points, not price areas. We're not looking at zones. We're looking at price points, right? So it'll be like support or resistance. So if you see somebody with like a 79 Fibonacci or a 72%, it must be that that's the price area for me in my translation. The important is that you understand what happens. So first things first, we said Fibonacci retracement, right? They serve as a measurement of the retracement of the previous trend, right? So if the market was going down and then all of a sudden the market started going up, you'll be able to understand based off the previous trend, how much in percent did the market retrace? Was it a full retracement? Did it retrace halfway and then started going down? Did it retrace 60% and started going down? That's important to understand. If you guys understand that, type 1. If you don't, type 0. Perfect. So, Kurt, if I'm using my Fibonacci retracement tool to measure the retracement of the previous trend, right?
Yep.
What am I focusing on? The beginning and the end of the trend, or where the trend was confirmed and ended? What would you think?
where it broke out?
Correct. And what confirms the breakout?
On the retest.
Correct. So, important rule, when identifying where to place your Fibonacci retracement levels, it's always best to draw and start your Fibonacci from retest of the previous breakout, right, to wherever you want to measure. So let's look at the chart real quick.
Cool.
So here we have, so when you're on TradingView, you're going to go down to the pitchfork and you're going to select Fib retracement. So I can see based off of here, right? Before I select that, let me go ahead and identify some zones, right? So here's the zone. Going off just simple price areas. Let's actually do this zone right here. So from low to low, right? Low to low, perfect. So the market broke out, retested, kept going. So when the market broke this level, it retested here. So I'm gonna draw my Fibonacci from this zone to, let's say, from here to here. I'm just gonna measure my Fibonacci from low to low. So this is the market going up. I'm actually going to bring this down just a bit lower to the bottom of the zone here, where the breakout occurred and retested. Perfect. So here's the market trending downwards, right? So the market trending downwards, retested, dropped. We went from here to here. 100% is here. The important thing is to understand what each of these percentages means, right? So we just drew this zone here. Perfect. Let's go back to our slides. I said to write down these levels because they're important, right? The 38.2, the 50%, the 61.8, and the 78.6, and the 88.6. Very important levels. The important is to understand what happens when the market fails to break them. So let's say the market went up, then it couldn't continue going any higher, so now it started going down. The first level to keep an eye out for is the 38.2. Now, I'm going to start off from the 23.6 level. This is the very first level that you would see in the chart. The important thing to understand is if the market fails to break the 23.6 level, you're always going to see a strong rejection to the upside. Now, the important thing is if it breaks the zone and continues going up, in this sense here, or if it respects the zone and continues going down. So one of the things I want you guys to write down is, and write this down right now, the higher the percentage, the slower the retracement. So I'll say it again. The higher the percentage, the slower the retracement, right? So again, the higher the percentage, the slower the retracement, right? So then that means the lower the percentage, the faster the retracement.
JL, what do you mean with that?
So the higher the percentages, right? So if the market, let's say this is the, I drew this Fibonacci based off this move right here, from here to here, right? If as the market is retracing, the higher the market drops to the percent, the slower the retracement back up is. Okay?
Okay, got it.
The lower the percentage, the faster the retracement. So here, let's talk about it here. And I'm gonna draw it on a blank screen so you guys can see it. So if the market was shooting up and it failed to break the 23.6, that tells you that there's gonna be a fast retracement back down. If the market shoots up, breaks the 23.6, right? Then that's gonna tell you, because it broke out, it needs to, if it's a fake out and it can't continue going any higher, it needs to come back and retest. So it's a slower retracement. If the market breaks past the 23.6 and the 38.2%, right? Then you're gonna see a what? Slower retracement back down. Perfect. If the market, again, breaks past all three of these levels and goes to the 61.8, what does that tell you? The higher the percentage, the slower the retracement. Now, most people say, JL, but in that example you sent me, or you just showed me earlier, it looked like the market shot to that point and came back up quick. Well, based off this Fibonacci that we drew here, right? We're drawing from retest of the fake out back down to the beginning. So here's the movement. The market shot down, right? Look what it did. It broke back above, it dropped all the way down here to the 50%, came back up slowly. I'll show you here. Came up, came back down, and then came up, right? And what did it do? It couldn't break this point over here. So this is where, if we were to combine what we've been learning, right, based off supply and demand, this is my lowest point. Going from low to low, low to low, right? I'm going from high to high, high to high. This zone is confirmed here. I'm going to change this to red so we don't get confused. So here it is, breakout. Market dropped to the 50% line, right? Shot up, retested, couldn't break back above. What did it do? Break below now. So what happens? If this is the area I need to focus on, right? When the market broke below and broke back above, where did it fail to break again? The area above. So what happened? The market came down, broke even stronger. This time, notice where the market broke. It broke this area here, right? Now you're asking me, yo, why did you draw this from here to here? Let's look left. If I were to look at the past and I were to identify my price area here, I could have been able to see that because of this zone here, had I extended this zone onwards, I could have seen when the market broke here, came up and failed to break again this price above here, and when the market dropped and retested, we were no longer retracing back up. It started just dropping, right? So we said earlier, the higher the percentage, the slower the retracement. What happened? Because the market couldn't break past that 23.6 here, based off the retracement back down, when it broke the 100% here and it broke our zone, right? What happened? The market could not find the strength to go up. So now let's talk about earlier. We said the lower the percentage, the faster the retracement. Cool. I'm going to delete all this. We're gonna go off of a higher time frame. I'm gonna go from I'm going off of this move right here, this strong move to the upside. Let me bring this down a little bit. So what happened? When the market broke and retested, it couldn't break the 23.6. Couldn't break the 23.6. Kept ranging around here. I would have found my zone here, right? Range. Notice what happened. When the market can't break the 23.6, look how instantly the market, it closed here and gapped upwards. Couldn't break. Did again. Now let's look at the 38.2. Here's my 38.2 line. The market couldn't break it. See how it couldn't break it? Faked out. What's the reaction? Strong push up. Couldn't break back above the 23.6 and broke below. What was the next reaction? Just kept going down. Does anybody have any questions in regards to what I'm showing you guys here? If it makes sense, type 1. If it doesn't, I need to make sure that you guys are all on the same page. Perfect. Let's see. Brandon, Evalio, let me know if you guys make sense. And we'll get into further explanations on how to use your Fibonacci. Perfect. Kurt, makes sense? Jose, Jaylene, Conrad? Perfect. So we spoke about fifth level. So the importance is to understand what? The higher the percentage, the slower the retracement. So we went off Fibonacci's based off the past, right? So how do we identify, how can I prepare myself for this move to the downside, right? So let's say I went from here to here, right? The market was going down and I'm measuring the retracement to the upside. So the importance is when targeting or looking to place your Fibonacci, you're looking for one move, right? One move to the downside. Notice how we did it. Notice how we did it from this move down, one move down, right? So I drew from retest to here. If I was taking my trade and I'm looking for the retest, what happened? The market broke below and came back above. If I was looking at my Fibonacci levels, and let's say I drew out my zones based off of my Fib levels. So I have a few zones here, and below that, there's more. Right? So then you say, all right, Jay, I want to try something out. I'm going to drag this down below to where this occurred. And I want to see where was it that the market failed to break above, and then it started dropping. So here it is. Market dropped downwards, right? And now we're looking for a retracement. So what happens? The higher the percentage, the slower the retracement, right? So what happened here? The market, after failing to break below here, it started retracing. So automatically the market shot up and hit this point here. What point am I looking at? It broke out of the 50% area, right? I drew my zone here. So my goal is to understand that if the market can't continue going back up, I'm looking for what? A slow retracement back down. So it came back, retested my 38.2, came, broke below, right? Then came back above, respected my 50, right? Came below, broke above. What is this? A slow retracement, right? Took some time, but notice how the market just started trending this way. Yeah, all right, I understand that it's not breaking my 50% line, but how can I confirm if this is going up or down? All right, I see my 50% line. I see that the market is trying to go up, but it can't. What else is happening? All right, let me identify what else is happening. Okay, I see the market trending upwards. If the market can't break this zone up here, you know, I see this inverted here. It could be possible that it can go up, all right? I see a rising wedge, right? The market shot up and then was creating higher highs and higher lows. All right, that's a sign that the market is going to retrace. So the market's not able to break my zone. So what happens? When the market broke below and not only retested the pattern that it did, but my 38.2, if I simply just go off a market structure like we spoke about, here's my uptrend, this is my last touch of the trend, right, which is also a zone right here. If I see once the market retested that area there, I knew that my uptrend was no longer valid and I was inbound for sales. Does that make sense? Type 1 if it does, type 0 if it doesn't. Perfect. So I understand that the structure changed on me. Not only what? When the market shot up to the 50% and it couldn't break it, I understood that I was inbound for a slower retracement had the market respected the 23.6% like it did right here. Notice what happened. I'm going to delete this area right here. The market shot up from start to finish, couldn't break the 23.6%. Look what the next candle was. A strong candle to the downside, but guess what? It couldn't break below here. So what did it do? Start retracing back up. You see? So the lower the percentage, the faster the retracement. From here to here, that's 60 pips. For those of you guys that look for quick trades, once you would have saw, okay, I drew my fib from here to here, and the market couldn't break the 23.6%. Or if I look at where the market is hesitating to break above or below, look, the market confirmed it here. It faked out, right? Came back up, faked out again, faked out. When the market shot up, couldn't break the 23.6%. My trade should have been that this was my possible entry. I mean, this should have been my possible take profit because that's the retest if it is going to go up. Make sense? Type 1 if it does. I want to make sure everybody's on the same page, and I'll ask one by one. Let's see. Brandon, how you feeling?
I feel good. I understand it. It was a good refresher.
Perfect. Does it make sense a lot to you?
Yeah, it does.
Awesome. How about you, Conrad?
Makes sense.
Perfect. Is there anything that's throwing you off, or you feel like you're ready to try this on your own?
I feel like I'm ready to try this on my own.
Perfect. Perfect. Always keep in mind, right? We're looking for one move. You know, and when we look for one move, it's just, you know, one move to the downside or one move to the upside so that we can measure the levels of retracement. So when we're looking at, you know, the higher the percentage of the market shot up, let's say a news event occurred, right? And it caused the market to shoot up prior to the market dropping, and you saw that the market couldn't break the 38.2, right? After that news event, what do you think the reaction is going to be? A strong push back down, right? But now let's say the market shot up, you know, to the, let's say, 78.6%, then you know it's going to be a slower retracement back down. Does that make sense when you think about like stuff that happens in NFP, you know, these crazy news events, and when they cause the market to either go up or down? You know, hence, look at AUDJPY. It dropped. I'm sure that it dropped to a higher percentage, which is why the market slowly retraced back up. Now, had that move been a smaller move, but a lot faster, right, then we couldn't expect an instant reversal right away. Dropped, came back up. Does that make sense?
Yeah.
Perfect. How about you, Evelio? How you feeling?
I'm feeling good.
Does it make sense, or you feel confused?
No, it makes sense. I just need to, you know, hear it again and hear it again so I could make it, you know, maybe better.
No worries, and it's recorded. The class is being recorded, so once I send the recordings, if you guys, you know, try to remember, this portion of the class is like towards the end of the video, so you can always just fast forward and listen to that again.
Mm-hmm.
But I'm glad that you're on board with us. Let's see, Jaylene, how you feeling? Hello? Oh, mic's not working? All right, good. Makes sense? You clears up some of the stuff you were concerned about? Perfect. How about you, Jose?
Yeah, man, we're super clear. We're good.
Perfect, perfect. Janelle, how you feeling, Janelle?
Good. It's really good. It's always good to see things over and over again to finally make them sink in.
Perfect. So remember, and I want you to try this when you're doing it on your own. So even if you're on a small time frame, right? Let's say you're looking at the 15-minute chart. You know, this is the market going up, right? See how the market went up here?
Yeah.
So this is a fake out. How do I know this is a fake out? Let's look at the past, right? This is where the market retested. I'm going to draw my fib level from here to the beginning. So when the market drops, right, and you notice what happened, the market dropped, it broke the 38.2, I mean the 23.6, couldn't break the 38.2. But once you saw that the market couldn't break back above the 23.6, if I would have looked left and noticed that this was my area here to pay attention to, once it would have failed to break that, the instant reaction was what? To the downside. Now, how do I verify that? Okay, if I'm drawing my Fibonacci based off of this trend here, right? And this right here is my last touch of the trend, right? What am I doing? I'm identifying the resistance. And once I identified that the market was not able, the market respected that area, I'm looking for what? The last touch. If this was the last touch, and once I saw that the market couldn't break it or respect it, I would have known what? the importance. If this was my high point, then my previous high should have been here. And if the market was unable to break above that zone, showing me that it was going to continue retracing, I was in position to take my trade to where? To the first point of the trend. Notice? Let me know if that makes sense to you, Janelle. So we use Fibonacci.
I probably would have taken it more to the 76%.
Correct.
Yeah.
And that's exactly what we'll talk about. So when managing a trade, right? I want to talk about this because I know you guys are more seasoned. If I take my trade, right, and I use Confluence, you know, I got the market faking out of a zone above here. I have market structure. I have the respect of an area. Perfect. If I entered at the 23.6%, the way I set up, if you guys ever notice when I send out a trade alert,
yeah,
my first take profit is always 1% after my entry. So if I entered at the 23.6% area, if this was my entry, my first take profit would be the 50%. Make sense?
yeah.
First TP. My second take profit would be 61.8. And third take profit is 78.6.
Yeah.
Even if those extra few pips, those are cool. Now, if I would have went off a market structure along with my Fibonacci, I would have been able to notice what? If my first touch or the respected area of the last touch is my entry, then my second touch is my first take profit, and the previous touch is my last take profit. Look how well this trade signal lined up. I entered here, first take profit, market came up. I could have entered it again after taking profit. My second take profit was what? The beginning of the trend. The market came back up. Cool, it dropped. Awesome, I'm waiting for the retracement. By the time all this would have happened, you probably would have been happy with your profits and you would have went about your day. Look how choppy the market was after coming back up. You see what I'm saying? So for us to understand this and to put it in basic terms, we spoke about Fibonacci retracements, right? We spoke about market structure. We spoke about candlestick patterns, right? What else is there that we need to identify to help us develop a better consciousness of what's happening, right? Is the important topic which we'll discuss today as well, which is understanding the current strength of the market. Now, I want you guys to write this down, right? We spoke about Fibonacci retracements and how the higher the percentage, the slower the retracement, right? The lower the percentage, the faster the retracement. Well, another key importance is FinViz. I like to use finviz.com, right? I click on Forex to know what the current strength of each currency is. And usually, the strongest currency to your left, right, paired with the weakest currency to your right, you'll always see either right now NZD is the strongest currency and the dollar is the weakest. If we look at NZD USD, you can see that it's been going up. And what do we have? The market going up, right? If I look at the weakest currency, let's say with the next currency, so you know that USD is paired with USD JPY. Let's look at USD JPY. In that sense, the market should be going down. And what is the market doing? Going down. Not as strong as we would want to see it, but it's been going down, right? Choppy. So if I analyzed my market and then I go back and confirm it with this, and let's say I said, okay, I expect the market to go up, but right now the current strength index is showing me what? That the dollar is weaker than NZD, and I was expecting NZD USD to go down. I might be early. What does that tell me? I got to look at what's happening. Okay, here's a zone. Here's the market breaking out of the zone. Maybe the market's going to come up to retest this zone before she continues going down. All right. What's another way we can confirm it? Well, this is one strong move down. So I'm going to draw my fib level from low to high, right? What happens? If I look at it right now, look how many times the market has been struggling to break the 61.8. The market fails to break this and close above, and then I go and look at Finviz and I see that NZD is now losing strength and the dollar is gaining strength. Then now I know that maybe my sell is in play because we have somewhat of a retest of some zone here. Now in this time frame, we spoke about, and I know it's a lot of information, but when we spoke about breakouts, right? A breakout in the 4-hour time frame has to be confirmed, right? In that same time frame. You guys remember that? So if the market confirmed that, right? Notice what happened. The market dropped, and now it came back up to here. If it fails to break above this level, and now I know if the next candle closes, right? We've always spoke about it's important to know what happens before and after. The next candle, the next 4 hours, the market closes below the 61.8 and then goes to the previous candle or shows us some type of candlestick pattern, then we know that for the long term, we can potentially take the trade to the downside. Our furthest take profit being the lowest point. And if I entered my trade, let's say on the 50, then my first take profit would be bam, 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 right? Moving down. Another thing to do is identify your market structure. And if this is my area where I'm trying to pay attention to, I would rather the market enter the market after the market respects that area, confirms that the trend is no longer valid, and then enter the trade going down. If everybody's with me, type 1. If you're not, type 0. Perfect. Now, I was thinking about talking about Elliott waves, but I feel like I've given out a lot of information, and I want to give you guys some time to digest and practice. So for your homework, I want us to work on identifying what we've been working on, right? We're working on identifying zones, right? Zones, let's draw some zones out. Have some zones here. We spoke about market structure, right? How the market changes from an uptrend to a downtrend. And how if we would have identified the last touch of that trend, right? We can see how the market tends to respect that area. So what I want you guys to do is, I want your homework to look somewhat like this, along with the fib levels, right? So this was my Fibonacci retracement level, and this was the retest here. So then I want us measuring that fib level going down. Notice what happened. The market dropped, kept breaking below, low, low. once it hit the 100, right a little bit above the 100% area, look how slow the retracement trying to go back up was. It was about from here to here, it was almost 2 days before the move to the downside occurred. Also, what confirmed that the market was no longer going up. Once we had here, retesting the level where it broke out, check it out, drop. All right, so I want to see fib levels, I want to see zones, I want to see, right, I'll do some more zones here. I want your charts to start putting everything into perspective. But this time, I want you guys to predict it on the 30-minute time frame. I want everyone's chart on the 30-minute time frame, predicting what can happen tomorrow. And then we'll look back at it and we'll see how the market winded up respecting your chart. Does anybody have any questions or anything they want to clear up before I let everyone go? Conrad, how you feeling?
I'm feeling all right. I'm gonna have to definitely look at the video again when you dropped it, maybe a couple times, but I'll get it.
Perfect. What's causing you to walk away right now feeling like you understand it completely?
What do you mean?
What do you think? Like, so based off of all the information I shared with you, I know it's a lot of information, right? But what's stopping you from saying, yo, I could do this?
No, I mean, I think I can do it. I just think I need a better understanding with the Fibonacci levels.
All right, so you do understand, like we've discussed, to keep it simple, right? The higher the retracement, right? The higher the percentage, the slower the retracement, right?
Yeah.
So here, good example. We went off, let's say we went off these fib levels here, right? One move to the upside. What happened? The market dropped down, failed to break below the 23.6%. Look how much faster the retracement level was, right? It didn't create a higher high in this sense, so the downtrend is still in play, right? So then it came back down and shot down to the 50%, right? Tried to go back up, couldn't break 32% above. Now, what did it do? It went for the 61.8%, right? When it failed to do so, look how much slower the retracement to the upside was. It faked out, and what did it do? Retest back above. So let's say I take my fib level from the lowest point to the highest point, right? And as the market is going down, notice what happened. It was breaking and retesting every important level just about to the point where we needed to see. Where now the market is breaking these levels and now respecting the exact level, but the halfway point. Look, halfway point. What is that telling me? I drew my fib level up here too high. So if I adjust it to the retest of where that fake out occurred, see right here where the closing of this candle was, or let's say I bring it down even lower. Let's see how much it matches it before we're looking at it. So here's my support, right? Look how clean when the market shot down, couldn't break the 23.6%, respected the zone we have here. What did it do? Come back down. What did it respect? The 38.2, respected our zone. What did it do? Come all the way down. See?
Yeah.
And notice what happened. The market dropped all the way up to here. Where did it come back and retest? Equally on like 61.8 and just kept going down. Now the beautiful thing, yeah, go ahead, bro.
Me?
Yeah.
Okay, yeah. Sometimes that happens to me too. When I draw my supply and demand zones, and then I use the Fibonacci tools, I see no confluence between my zones and the Fibo levels. What did you do right now to look for the confluence?
Yeah, so I went off of, so I was just adjusting my zones, right? I mean, my fib level. So we spoke about one movement, right? So you see how this is one movement to the upside and then the market came back down?
Yeah.
Sometimes the focus shouldn't be on dragging it as high as to the highest point. Sometimes it's also looking, right? The importance is what happened before. So let's say I would have drawn my zone from here, let's say from high to low. Excuse me. I went off the zone over here in the left.
Okay.
Right? The left, right over here. You see how the market broke out, shot up, retested, shot up, faked out, shot up, right?
Yeah.
Broke above and retested this level here. Notice when the market dropped, it came back up to this level here. I don't care about the high point. I care about the retest because see how it broke out, retested, couldn't create a higher point and then drop. I'm going off this candle here. Why? Because this is the retest of this level over here.
Okay.
So if I drew my fib level from here to here, as the market was going down, see how it started respecting my level cleanly? Shot down, respected the 23.6%. What was the reaction? Look, strong candle to the upside. You see that?
Yes, sir.
Respected my zone, couldn't break above. What do we have here? A pin bar.
Mm-hmm.
Right? So what did that signal? The next candle. The important thing is not what happens, but also what happened before, but what happened after. What do we have here? 3 inside down pattern. Signals the market going down. So then the market broke below. Right? Look, what is this? My 23.6. When the market broke below, couldn't break above, the next candle engulfed it, dropped. Where did it respect? My 38.2. You see that?
Yes, sir.
And then what happened? We have this decision candle here. The next candle, the important thing, went down, right? Where did it respect? My 50.
Mm-hmm.
Couldn't break above. If I look at the past, right, based off of what happened in the past, I can see when the market broke out, it never retested. So when it broke back in, it retested. What did it do? Keep going down. Where's the next stop? 61.8. You see?
Yes.
The importance is to identify it. So let's say we would have, I'm going to delete this fib level. I'm going off this one movement, right? From here to here. Notice what happened. The market broke below the 23.6, couldn't break above, and our zone, what did the market do? Break. Where did it stop? The 38.2. It couldn't break above the zone or the previous breakout level. It retested it. What was the reaction? Down. To what level? My 50. Notice how every time it reached this level and couldn't break above, what was the next reaction? Down. Broke below the 61.8. Where did it retest? That same level. Kept going down. You see?
Yes.
So the important thing is to understand a failure to break above requires a retest, right? Or a breakout requires that retest. So if I'm going off a market structure, right, the last touch of my trend, and let's identify that right here. Right? You see how the market trended from here to here. Look at the last price it touched. I'm going to identify that area. Where did the market retest when it broke below? Excuse me. The market broke below, came back, retested my zone, and dropped. You see how you can use Confluence with your zones and fib levels and market structure to identify the best possible trade? If I would have taken my trade from here, and I would have known the previous structure, right? This was a previous uptrend. This is the reaction. Here's a good sign, all right? Here's the market going downwards, right? Bullish movement, falling wedge, continuation. The market shot up, couldn't retest and continue going higher. So where's the market gonna come to? Right? It broke below that. Where did it fill? To here. It broke below, retested, continued going down. All I gotta know is what happened prior to that. See? So I want you guys to apply this, and then if you guys have any questions while applying it, make sure you put it when you submit your homework, what questions you had. So tomorrow, when we go over this, we're working on it, on what you're not understanding. Let me know if that answered your question, Yalan.
Yeah, bro.
Perfect.
I didn't know that I can adjust the Fibo level. I always did it from swing high to low and vice versa.
Yes. When I was teaching you how to identify Fibonacci levels, we started off by speaking about the swing high and the swing low, right?
Yeah.
The importance is to understand the movements, right? Because if I simply just draw my fib level from the lowest point to the highest point, it's not always going to be as clean as we want it to be, right? But check this out. Swing high to swing low, when the market broke below the 23.6 and retested it, what's the continuation? To the downside. See that?
Yes.
It never respected the 38.2. So at some point in time, the market, if it does come up, that is an area to pay attention to. Because it just broke it and never retraced to retest it. Make sense?
Yeah.
So if the market breaks above, what I'm trying to tell you is simply, the market breaks above and starts making its way up, an area you should pay attention to is that price over here. Or any price that when it broke out, it didn't retest. Make sense?
Yes, sir.
Perfect. So I'll see you guys mañana, and I'll upload the recording in a few minutes.
Hasta mañana, Diego. Thank you.
Have a good one.
You as well. Good night, everyone.
All right, good night.